I mean, I don't think that's who I am at all, but I understand why they're saying that.
Appearing on the cover of Forbes magazine with the headline, 29-year-old becomes world's richest self-made young billionaire, boasting a net worth of $22.5 billion in 2021 and hailed as the king of crypto, this individual seemingly had it all except freedom, as he fell into legal trouble prematurely. So, who is he? How did he amass such rapid wealth? And what exactly transpired in his case? Join us as we delve into the reasons behind the downfall of a crypto icon in less than a week. Sam Bankman-Fried was born into an intellectually rich family, with both his parents serving as law professors at the prestigious Stanford University. From an early age, he showed an exceptional aptitude for numbers and logic. His graduation with a physics degree from the Massachusetts Institute of Technology, MIT, in 2014 was a clear testament to his sharp intellect and superior analytical thinking. Before venturing into the crypto world, Sam worked at Jane Street Capital, a top-tier quantitative trading firm on Wall Street. There, he gained invaluable experience in financial markets, high-speed trading, and risk management, skills he later applied, or perhaps should have applied, to his own empire. By 2017, recognizing the explosive potential of the crypto market, Sam decided to branch out and founded Alameda Research, a crypto-focused hedge fund. Just 2 years later, in 2019, he launched FTX, a cryptocurrency exchange with a vision to become the world's leading platform for derivatives trading. FTX's growth rate stunned the world. In a remarkably short time, FTX rapidly ascended to become one of the largest cryptocurrency exchanges globally. Sam transformed FTX into a true giant, attracting millions of users and processing billions of dollars in daily trading volume. Sam himself became a self-made billionaire before the age of 30, with Forbes estimating his net worth at $26 billion at its peak, placing him among the world's wealthiest individuals. He wasn't just a successful entrepreneur. He was also a highly influential figure in American politics, spending tens of millions of dollars on lobbying efforts and political campaign contributions. Sam's personal image was also quite distinctive. He often appeared in public with messy hair, shorts, and a t-shirt, even when meeting politicians or billionaires. This cultivated an image of an unconventional, talented, yet unpretentious prodigy. He was also a strong proponent of effective altruism, committing to donate most of his wealth to charity, further burnishing his public image. Despite the glamorous facade, fatal flaws existed within Sam's empire. The relationship between the FTX exchange and the Alameda Research hedge fund was not simply that of sister companies, but a tangled and opaque financial web. This was at the core of the problem. Alameda Research, under Sam's and later Caroline Ellison's direction, was secretly allowed to use billions of dollars of customer deposits from FTX without proper oversight. In essence, FTX users' money was funneled to Alameda to make risky investments, acquire luxurious personal assets, like expensive real estate in the Bahamas, and prop up other failing projects. This fundamentally violated the core principle of a cryptocurrency exchange, where customer funds must be segregated and kept secure. The problem became clearer when a CoinDesk report in November 2022 revealed that Alameda Research's balance sheet was largely built upon FTT tokens, FTX's own proprietary cryptocurrency. This period was extremely critical. The crypto market had been going through a prolonged crypto winter, with many projects and investment funds already struggling. This backdrop made information about companies' financial health more sensitive than ever. This report was the spark that ignited the collapse just a few days later. One of the most shocking revelations, and central to the criminal case against Sam Bankman-Fried, was that FTX secretly lent billions of dollars of customer funds to Alameda Research. This wasn't merely a risk management error, it was a blatant abuse of funds, shattering every fundamental principle of finance and user trust. To visualize this, imagine FTX as a large bank where millions of customers confidently deposit their savings. The bank's ultimate duty is to keep that money safe and only allow depositors to withdraw it when they wish. However, Sam effectively turned FTX into a personal ATM for Alameda Research. Instead of segregating and safeguarding customer funds in dedicated, secure accounts, as expected from a trustworthy financial institution, FTX clandestinely diverted billions of dollars of client capital to Alameda Research. This illicit transfer was facilitated through a backdoor within FTX proprietary system, which granted Alameda an enormous, virtually unlimited line of credit without requiring adequate collateral, unlike conventional lending arrangements. This action constituted not only a blatant breach of FTX publicly stated terms of service, but also a severe felony. These colossal sums, which were supposed to be protected for FTX clientele, were not utilized by Alameda Research for legitimate trading activities or prudent investments. Instead, these billions were deployed for various illicit purposes, including high-risk ventures. Alameda extensively funneled funds into speculative and high-risk cryptocurrency projects, nascent startups, and highly illiquid assets, those difficult to convert into cash quickly. As market conditions deteriorated, the value of these investments plummeted, inflicting substantial losses on Alameda and exacerbating the burden on customer funds. Lavish personal expenditures. A significant portion of these misappropriated funds was diverted to acquire extravagant personal assets for Sam Bankman-Fried and other senior executives of FTX Alameda. This included multi-million-dollar real estate in the Bahamas and substantial political contributions, amounting to tens of millions of dollars, starkly illustrating the egregious misuse of client capital. External debt repayment. Alameda also leveraged customer funds to settle debts owed to external creditors. This maneuver was a desperate attempt to maintain a facade of financial health, despite the reality of deep-seated insolvency within the fund. The entirety of this fund transfer and utilization process was executed with extreme secrecy, completely devoid of any internal oversight or public disclosure. FTX's balance sheets and financial documentation were deliberately manipulated to conceal Alameda's colossal liabilities. As previously discussed, Alameda used FTT, FTX's native token, as collateral for these loans. This posed an exceptionally dangerous risk because FTT was a self-issued asset, lacking substantial intrinsic value independent of the FTX ecosystem. Consequently, as the price of FTT declined, the value of this collateral diminished rapidly, transforming Alameda's debt into a seemingly bottomless black hole. Despite billions of dollars in customer funds having effectively vanished into Alameda, FTX continued to operate business as usual, accepting new deposits and projecting an image of a secure, reliable exchange. This effectively created a Ponzi scheme in disguise, where incoming customer funds were illicitly used to sustain operations and cover prior losses, until the unsustainable structure inevitably collapsed. This created a perilous circular risk. Alameda's value depended on the price of FTT, and the price of FTT in turn relied on market confidence in FTX. When Binance CEO Changpeng Zhao, CZ, publicly announced his intention to sell all the FTT tokens Binance held due to concerns about Alameda's financial health, a massive sell-off ensued. The price of FTT plummeted, dragging down Alameda's asset value and creating a giant, unfillable financial black hole. As news of Alameda's precarious financial situation and FTX's inability to meet withdrawals spread, a frantic rush to withdraw funds occurred on the FTX exchange. Customers panicked, trying to pull their money out but couldn't, as much of their funds were no longer held by the exchange. In just a few days, a multi-billion-dollar empire vanished. On November 11, 2022, FTX officially filed for Chapter 11 bankruptcy in the U.S. Sam was arrested in the Bahamas a month later and swiftly extradited to the United States, facing a litany of charges including fraud, money laundering, and other related crimes. The collapse of FTX and Sam's fraudulent actions caused severe damage to millions of investors worldwide, with estimated losses reaching billions of dollars. Countless small investors lost their life savings, while large investment funds also incurred massive losses. This incident not only shook confidence in the entire cryptocurrency market, but also spurred regulatory bodies globally to act more decisively, pushing for stricter regulations to protect investors and prevent similar occurrences in the future. For Sam Bankman-Fried, once a symbol of the new generation of crypto entrepreneurs, his fate completely changed. In November 2023, an overwhelming federal jury in New York found Sam guilty of fraud and related charges. By March 2024, he was officially sentenced to 25 years in prison for defrauding customers and investors. This was a heavy sentence, sending a strong message that no one is above the law, regardless of their talent or influence. The story of Sam Bankman-Fried and the collapse of FTX is a modern tragedy, where ambition, a lack of transparency, and misconduct led to catastrophic consequences. It serves as a stark reminder that no matter how advanced technology becomes, fundamental principles of ethics and sound financial management will always be the core foundation for sustainability. What are your thoughts on this complex story? Do you think the crypto industry has learned its lesson, or are there still more risks lurking beneath the surface?